Well, Hungary is very interesting because it's obviously part of the Visegrad Four and has been part of the Visegrad Four since the capital markets opened up, really, but it's suffered in the period immediately post 2010, the election of Fidesz. Investment dried up, essentially, relative to the rest of the region, and risk had to be priced in with the more populist government that came to power in Hungary, and investment volumes were very weak throughout that period, 2010 to 2013. But what we now see is that Hungary's got through the fire. Hungary has gone through the fire, and the risk now in Hungary is understood. We don't have uncertainty in Hungary. We know the Fidesz government's in place. We know how they have operated in terms of their relationship within the economy, within the capital market, and therefore investors are able to price that in rationally. Now, what's very interesting, obviously, is the rest of the world is facing some of these issues. Whether we look at Poland, whether we look at America with Mr. Trump, President Trump, if we look at even the Brexit situation in the UK, or what might happen in France or Germany this year, we've got situations which are throwing up a huge amount of uncertainty. And Hungary doesn't have that anymore. And therefore Hungary, with its yield levels of 8% in industrial and around 6.5% in office and retail, probably is looking at some compression and moving down towards the levels that we're seeing in the other Visegrad countries. So the outlook for the yields looks, for the next few months, notwithstanding any movements upwards in bond yields, looks quite good for the moment in Hungary.